Welcome to our seminar today. My name is Susan Grassley. I'm an attorney and I help with all things Affordable Care Act. Our seminar today is entitled ACA Compliance, the Measurement Methods under Employer Shared Responsibility, and this is actually part 2. Correctly administering and applying your measurement methods. So there is a part 1 that goes into more detail, and now we're on part 2. If you have not heard or listened to part 1, please stop at this point and go back and listen to part 1 first. So the basic parts of the ACA need to be reviewed first before we move on. We have 4 parts. We have the individual shared responsibility, sometimes referred to as the individual mandate. We also have the employer shared responsibility, sometimes referred to as the employer mandate. And we have exchanges, also referred to as marketplaces. We have all kinds of names for things. And the subsidies that can be found there, or an individual can be eligible for if their household income falls within certain parameters. And then we have everything else, which is basically to say that there are a lot of other Affordable Care Act provisions that employers need to be aware of. And those are most of those are part of market reforms. Today we're going to be talking about employer shared responsibility. So when we talk about the employer shared responsibility, we're going to break it down into 5 areas. 3 of the first areas will be reviews. We'll briefly review the steps to compliance. That is a separate seminar, and we will not go into details on that at all, but just kind of skim over that. You'll need to review and listen to that if you have not yet done so first before you listen to this presentation. Second, we're also going to have a brief review of the measurement methods. The measurement methods and the third part, the brief review of the look-back measurement method, are all discussed in detail in part 1 of this seminar, the part 1 that's called the measurement methods. It is really important that you listen to that seminar first because we're just reviewing and skimming that today, and you need to have the details. So like I indicated before, if you haven't listened to part 1, please turn this off and listen to that first before you move on to this one. 4, we're going to talk a little bit about the issues and complications that arise when using the measurement methods, and in particular the look-back measurement method. And then we're going to go through several examples in detail so that you can sort of wrap your head around how to actually apply and administer the rules. So we're going to review the rules so that you have a brief review of that, but hopefully you've had that full education before this seminar. And then we're going to walk through some examples. So we're going to go to our first review, which is the step to compliance. Our first step to compliance, for those of you who have been through these steps, are, as you recall, step 1 is determine your size. Then you needed to determine your compliance date. It used to be that we had one compliance date for all employers, and now we have a wide variety based on some delayed compliance dates. So we figured that out for you in step 2. Step 3 is determine what will be offered. That was when we discussed whether you're offering and checking whether you're offering minimum essential coverage, whether it meets minimum value as well, whether it meets affordability as well. And then step 4, we walked you through determining which employees will be offered coverage and when. And the way you determine that is to get educated on some more issues and put together an actual written measurement method policy. So today we're talking about that written measurement method policy that you have completed, and now that it's completed, how to actually administer it correctly. So the measurement methods were created to help you avoid exposure to employer shared responsibility penalties. I know the measurement methods can be a little bit of a pain until you kind of wrap your head around it, but they do help you. They can be your friend if you will apply it correctly. If you'll put one together that's written and then you apply it correctly. And this is why you do not want to be stuck with some penalties. Let's review quickly what the penalties are. We have the non-offering penalty, which is technically referred to as the 4980HA penalty. And that's the penalty where if a large employer does not offer minimum essential coverage, or MEC, M-E-C, to at least 95% of your full-time employees and their dependents. Now, you'll notice here on the slide that in 2015, that percentage was 70%, but from 2016 forward, it's 95%. Now, the way that penalty is calculated, we're going to skip just to the 2016 calculation, which is, it used to be a $2,000 penalty, but it was indexed for inflation. So we have, if you look at the line that says calculation in 2016, the amount that you multiply is not $2,000 but $2,160, and you multiply that by all your full-time employees minus the first 30. And that is the total amount of the 4980HA penalty if you are exposed to that. The other penalty is referred to as the affordability or minimum value penalty, but technically it's referred to or called the 4980HB penalty. Now, this penalty applies where you happen to offer, you were great, you did great on your identifying and offering to all your full-time employees, or at least 95% of your full-time employees and their dependents, but what you actually offered to them was not affordable or did not meet minimum value. Now, the calculation for that also is a little bit different than the original the original number. The original number was 3,000, but skip down and look at the slide that says calculation in 2016. In 2016, the calculation will be, for any penalty based on this, is $3,240 multiplied by the number of employees who actually went to the exchange, the individual exchange, and qualified for and actually used a premium tax credit. Now, these penalty amounts that I've just walked through for both the A penalty and the B penalty are annual amounts. In other words, this amount assumes that you would owe a penalty for all 12 months of the calendar year. That may not be the case, and a lot of times it's not. In a lot of cases, you may owe a penalty for certain months of the year and not other months. That's maybe because you identified mid-year that you had missed somebody or you weren't affordable and you made adjustments. So you would, to get the penalty amount for the monthly, you would take that figure, whatever that is. Let's look at the calculation in 2016 under the B penalty, that's $3,240, and just divide that by 12, and that would give you the monthly penalty. Now, when is a penalty imposed? Remember, this is just review again. We talk about this more in the prior seminars that you should have already listened to. But this penalty is imposed only if at least one of your full-time employees goes to the individual exchange and qualifies for and uses any of the subsidies, specifically the premium tax credit. So the measurement methods were set up to help you avoid this and avoid those penalties, and the measurement methods help you correctly identify which employees had enough hours of service to be full-time. So what you want to do, and what we helped you do in step 4, is document your policy in writing, which we call the measurement method policy. And then after you've done that, and which you did in step 4 as well, which is you're going to update all your documents, meaning you're going to update your SPD, you're going to update your plan document, and any kind of employee communication that discusses how you become eligible, including the employee handbook. So you're going to want to update all that information. Now, here's reminders generally on the measurement methods, just sort of an overall. First of all, identifying full-time employees is based simply on tracking and counting hours of service. Remember, if you call somebody seasonal or part-time, they may not technically be seasonal or part-time under the Affordable Care Act employer shared responsibility provisions. So kind of shift your thinking to for ACA purposes, I am tracking simply hours. I am counting hours, and that's how I identify. That's how I identify whether somebody's full-time or not. Now, all hours of service should be counted when tracking hours. And in other words, hours of service include hours actually worked, plus hours for which an employee is paid even though they didn't actually work it. And that would be, for example, holiday leave or sick leave or so on. Full-time employees under the ACA are those employees who average 30 hours of service per week or 130 average hours of service per month. I refer mostly to this full-time as 130 hours per month, but know that you do have the option of tracking on a weekly basis. It's actually to your benefit if you do it on a monthly basis, if you'd like to know the answer to that question. A full-time employee's dependents are defined as an employee's children up through age 26, and those should be offered as well, and you do not need to offer to the spouse. So of course many of you do, and that's fine and that's great and really positive, but you just won't be penalized if you don't. So here's our next section, which is again a brief review of the measurement methods. There are two measurement methods to track hours of service and identify full-time employees. We have the monthly measurement method and we have the look-back measurement method. Now with the monthly measurement method, this is typically only going to be used temporarily. But for those who have this method temporarily, you're going to count each employee's hours of service individually on a monthly basis. So it is just what it sounds like, and employees could go in and out of eligibility for coverage on a monthly basis. With the look-back measurement method, just overall generally, you're going to be tracking an employee's hours of service during a specified look-back period, which is usually 12 months. And employees whose hours of service average over that 12 months at 130 hours per month, those are the ones who are identified as full-time and should be eligible for coverage and should get or be offered coverage for a full following 12 months, which is referred to as the stability period. Now, something we need to remind you as well, which is a review, which you should have learned in the prior measurement methods seminar, but there are two different kinds of look-back methods. You have the standard look-back method and you have the initial look-back method. Now, generally, overall, employers must use the same measurement method for all employees. Now, that would mean that if you select the look-back measurement method, you would use it for all of your employees, including full-time, part-time, seasonal, salaried, paid by the hour, and so on. There are some exceptions to this rule, and we go over them again in detail in the prior seminar, but just as a review, some exceptions are optional and are limited to 4 specific allowable categories, and we go over that in the other one. Also, some exceptions are required, and that is the one that must be applied to newly hired employees who are at the time of hire are reasonably expected to be full-time. So, the measurement method that is commonly used, plus is typically most beneficial as well as simplest and easiest to administer, is to select the standard look-back measurement method for all categories of employees. And again, like I said on the last slide, this means that you would be using that method for all of your employees, including full-time, part-time, variable, seasonal, paid by the hour, paid with salary, employees at all locations, and so on. Now, you are required to use an exception. In other words, you are not going to use the standard look-back measurement method for certain employees, and this is a review of that. First, you're going to use the monthly measurement method temporarily for newly hired employees who are reasonably expected at the time of hire to be full-time. Also, you're going to use the initial rather than the standard look-back measurement method. And again, that's temporarily for newly hired employees who are not reasonably expected at the time of hire to be full-time, and for newly hired employees who meet the Step 4 seasonal employee definition. So you've got two categories there. And again, this is reviewed in the part 1 of the seminar. But here's an overall review of how it works. And I think this picture, at least for me, helps, and I'm hoping it helps others. I've gotten feedback that it really does help with the big picture. This is assuming that you select the look-back measurement method for all categories of employees. If you do not select it this way, you're going to have a much more complicated flow chart, but this is what it would look like if this is what you select. You have 3 buckets, and those are the only buckets you have to worry about. You've got your newly hired employees who are reasonably expected to be full-time, and temporarily they go into the monthly measurement method, and then eventually they get transitioned into the standard look-back measurement method, and they stay in that the rest of the time. Unless they leave, and there are exceptions to that, and we'll talk about that. The second bucket, newly hired employees not expected to be full-time, plus full-time employees who meet the seasonal definition who are also newly hired. Temporarily, these employees go into the initial look-back measurement method, but are eventually transitioned into the standard look-back measurement method with everybody else. And then you have your third bucket, which is ongoing employees. And those are employees who were with you and working for you prior to your starting your measurement method process. So for those employees, they're automatically going to be put in the standard look-back. There's no temporary process for them. Okay, so here's a review really quickly of the look-back measurement method. We just talked about the measurement methods in general, and that was those were 2. Those were the monthly measurement methods and the look-back measurement method. Now we're going to talk about the look-back measurement method. We're not going to be discussing the monthly anymore. So here's some reminders with the look-back measurement method. There are 2 methods within the look-back. We have the standard look-back and the initial look-back. So typically, well, not typically, always, you're going to use the standard look-back for all ongoing employees. So that includes any employee who was hired prior to the employer's first or original standard measurement method, or your first measurement method ever, first ever standard measurement method, and any employee who has worked through one full standard measurement period. So they weren't originally, they're newly hired after you start, but then they have worked through one full standard, then they are transitioned in and become an ongoing employee. So you're going to use the standard for those. Now you're going to use the initial look back for certain newly hired employees, and those are going to be newly hired employees who at the time of hire are not expected to work full-time. Remember the chart just on the slide before. Those go into the initial at first and then get transitioned into the standard. You're also going to use this for newly hired employees who at the time of hire meet the Step 4 seasonal employee definition. We talked about that on the slide prior to. So seasonal employees who are officially seasonal employees, not those who you call seasonal employees, but those who meet the definition. And there's a specific definition we talk about in the other Part 1 seminar. And then you're going to stop using this method after these employees have worked through one full standard measurement period, just like in the other. So everybody who becomes an ongoing employee then gets put into the standard. And that's basically what we're saying there. And again, here's our chart just as a review. We've got the 3 buckets. Newly hired employees reasonably expected to be full-time. They go temporarily into the monthly measurement method and are transitioned into the standard. The second bucket is newly hired employees not expected to be full-time and newly hired employees who meet the seasonal employee definition. They go temporarily into the look-back method, but it's the initial look-back because they're newly hired, and then they get transitioned into the standard. And then again, we have our ongoing employees, those who were already with the employer, with you, working for you prior to the start of your measurement method policy. So again, this chart assumes that you've selected the look back measurement method for all employees, which is what we are recommending. So here's the process. First of all, we're going to talk about the standard look back, and then we're going to talk about the initial look back. And again, this is going to be much briefer than the detail we go into in part 1. So for the standard, we select, we track, we do the math, we offer, and we repeat. The standard look back review of all those 5 steps. Select. You're going to select the length of your measurement period, typically 12 months. You're going to select the length of your stability period, which is typically 12 months. I say typically because almost everybody that I work with has selected 12 months, which is wise. And select length of your administrative period, which is typically 2 months. It can be 1 month if you'd like it to be, but the most common and the one that gives you a little bit more time to do your administrative work is 2 months. Track. You're going to track all hours of service for all employees during the measurement period. Third step, do the math at the end of the measurement period and during the administrative period, which the administrative period is basically the do the math and offer section. You're going to add the total hours and divide by the length of the measurement period. And our fourth step is offer after doing the math. And again, this is still during what we call the administrative period. You're going to offer coverage to those who are full-time, and those, again, were those who averaged 130 hours per month during that measurement period. And you're going to offer to them even if their hours go down after the measurement period, because they're sort of locked into that eligibility because they averaged 130 hours over that 12-month period. And make sure the coverage is effective day 1 of the stability period, or they have the option of having the coverage be effective day 1 of the stability period. And then repeat. As soon as the measurement period ends, another measurement period begins. As soon as the stability period ends, another stability period begins. So that's the overview of how the standard look back measurement method works. Here's a graphic of how it looks. You've got your measurement period, your administrative period, and your stability period, and then you just repeat. As soon as measurement period 1 ends, you start measurement period 2 again, and as soon as stability period 1 ends, you start stability period 2. So here's an example of a typical standard look back cycle where the employer has selected a 12-month measurement period, where they selected a 12-month stability period, where they selected a 2-month administrative period, and where their plan year starts January 1. And where the employer exposed to penalties, or your step 2, when you went through your 2 steps. Step 2, we determined what your compliance date is, and in other words, when you're exposed to penalties. And in this example, this employer is exposed to penalties January 1, 2015. So the dates of the first standard look back cycle, which would be a total of 26 months, and again, assuming the 5 factors above. November 1st, 2013 to October 31st, 2014 is your standard measurement period 1. That is because you're doing this prior to your effective date. Remember, your effective date is January 1, 2015, but you've got to have know who your full-time employees are by that time and have them offered coverage by that time, so you're in compliance. So that's why we started back in November of 2013. Your administrative period 1 is November 1, 2014 through December 31st, 2014, and then the stability period is January 1, 2015 through December 31st, 2015. So again, that just repeats exactly the same way because it happens they've got the 12-month cycle and you just change the years. So the next standard, or the second standard look back cycle, would be November 1st, 2014 through October 31st, 2015. Then the administrative period would be right after that, November 1st, 2015 through the end of the year of 2015. And then the standard stability period would be January 1, 2016 through January 31st of 2016. And then again it repeats the following year. So that is a review of our standard look back. Now we're going to discuss the initial look back, which is similar in a lot of ways to the standard, but has some unique differences and some important differences. So we select, we track overlap, we do the math, and we offer, and then we don't repeat. So let's talk about that. The selection is very similar to the standard. You're going to select the length of your measurement period, which is typically 12 months. We're going to select the length of the stability period, which is typically 12 months, and we're going to select the length of the administrative period, which is typically split to 1 month plus a partial month, but you have the option of not having a split. And again, we talk about that in part 1 in seminar, measurement method seminar part 1. You're going to track. You're going to track hours of service just like you do with standard. However, you're going to start tracking hours of service at the time of hire for your initial measurement period. And then you're also going to track hours of service at the first standard measurement period after hire that starts after hire. So for the newly hired employees who are in the initial look back method, you're going to be tracking in 2 separate cycles. You're going to be tracking in the initial, which starts at the time of hire, and then within the standard, which starts with the first standard after hire date. So then you're going to do the math at the end of each of the measurement periods, at the end of the initial measurement period, and then again at the end of the standard measurement period. You're going to add the total hours and divide by 12. In this case, it would be 12. Then you're also going to offer, and again, do the math and offers during the administrative period. But you're going to offer coverage effective day 1 of the stability period to those who are full-time during the initial, and you're also going to offer separately, figure and offer separately to those who were full-time during the standard measurement period. So 2 different trackings, 2 different results possibly. They could be the same result, but they might be part-time in the initial and full-time in the standard, or vice versa. Treat them differently and separately and use both. Do not repeat. In other words, the initial look-back cycle happens only once. Hours continue to be tracked in the standard look-back cycle, but you're going to drop off the initial look-back after the first cycle. So here are the initial administrative periods. You've got administrative period part 1, which is a partial month. For example, if somebody's hired on March 17th, it would be March 17th through the end of the month. Then you have your initial measurement period, which would start in April. And then your administrative period would be 1 full month. And then you would have your initial stability period. Or you could choose to have your administrative period be just sandwiched in between and not have the split. You could just have it the 1 month in between the initial measurement period and the initial stability period. We talk about the pros and cons of this in part 1 of the measurement method seminar. Here's an example of the typical initial look-back cycle where that employer selected a 12-month measurement period, selected a 12-month stability period, and selected a 1 and a partial month split administrative period, which is the administrative period that we recommend because it's easier for you to administer. And it sounds like it's kind of difficult, but it's not. And I'll explain why. The dates of the same employer standard look-back cycle starts, the standard starts every November 1. The standard administrative period goes through November and December of each year, and then the standard stability period goes from January through December each year. So, at the time of hire, John, who's newly hired, is not reasonably expected to be full-time, and so therefore he would be put into the the look back cycle, and he would first be put in the initial and then be put in the standard. So let's talk about the dates. May 12th, 2016 is his first day of work. So May 12th, 2016 through the end of the month is part 1 of the split initial and administrative period. June 1, 2016 starts the initial measurement period, and that goes for 12 months. Then November 1, 2016 is the start of the standard measurement period. So that's when you're also going to start measuring this employee's hours or tracking this employee's hours of service in the standard. So now you've got 2 cycles you're keeping track of. May 30th, 2017 is the end of the initial measurement period. And then for the initial cycle, you'd have June 1, 2017 through June 30th is part 2 of the split initial administrative period. July 1, 2017 is day 1 of the initial stability period. So if John averaged 130 hours per month in that initial measurement period, he would need to be, and he opted in, he would need to be on coverage by July 1. Now, when we hit October 31st, 2017, we hit the end of the standard measurement period, so we're going to do some calculations there during the administrative period. November through December of 2017 is that administrative period, so if he averages 130 hours in that time period, he's going to need to be offered coverage, and if he opts in, he's on coverage January 1, 2018 through the full year. So here's a visual of how the track overlap works for the initial look back method. You have the initial measurement period and the administrative period and the initial stability period. This is not a split one, a split administrative period. And then that drops off and you continue with the standard look back cycle each year after that. So let's talk about common questions that apply to both the standard look back and the initial look back that we always get. Question 1, during the measurement period, must I count all hours an employee works, or can I cap it at 40 hours per week? No, you cannot cap it. You must count all hours that are worked, including overtime hours and including any hours of service. Those are hours that they may not have worked, but they were paid for. Question 2, do I have to count hours an employee is on leave or vacation? Yes, you count all hours of service for which an employee is paid or entitled to payment, including, for example, sick leave, annual leave, holiday leave, specially protected, special unpaid leave. This also includes disability benefits if the employer paid premiums, but not if an employee paid premiums with after-tax contributions. So we sometimes get questions about disability and if that's counted as hours of service. Question 3, how do I track hours of service for employees who are not paid by the hour? We talk about this in the part 1 of the measurement methods, but what you do is you have a couple of options. You have the option of just starting to track actual hours of service, which is on paper the simplest way of dealing with it. I know in reality sometimes it's not, but that's an option. Or you can use the equivalency method. The days worked equivalency method is where they get 8 hours of credit if they worked at least 1 hour in the day. And if you use the weeks worked equivalency method, they get 40 hours of credit for the week if they worked at least 1 hour. So you cannot use these equivalency methods in a way that would understate an employee's actual hours. In other words, to manipulate it so that you count a full-time employee as a part-time employee. Here's another common question that applies to both the standard and initial look back. Must I offer benefits to an employee for the rest of the stability period if the employee's hours drop and employee only works part-time? Yes, that's the point of the stability period. Once they earn it in the measurement period, if they did earn it, if they averaged 130 hours, they are locked in for the full stability period. Now there are exceptions to this rule that we're going to be discussing in this presentation and that are also discussed in the Part 1 presentation. But generally, yes, you must keep them on. Must I continue to pay for benefits for such an employee? In other words, I know I need to offer it, but do I have to pay for it? So here's some things to think about. The ACA does not require an employer to pay any particular amount or pay same amount for all employees who have coverage, but you have to be affordable in order to avoid penalties, but we're going to talk about that. But you may need to continue to pay for other reasons. You need to check whether the employer must comply with carrier requirements for minimum employer contribution for all eligible employees. You need to check whether the employer contribution and you need to check whether the employer contribution and any of your employee communications explains this, says that the employer is paying a certain percentage, for example, 75% of the employee-only coverage for all eligible employees. If in fact you are promising to pay 75% and you've communicated that to your employees, and then you change that because they've reduced their hours, you might not be able to do that, so check into that. And then finally, check whether reducing the payment that you make toward the coverage for that employee remains affordable, because you are still on the hook for affordability, which we talk about in our 4 steps to compliance, another seminar. But it could make you, if you reduce your contribution enough that it makes it unaffordable, then you are still going to be exposed to employer shared responsibility penalties. Okay, now we have done our review of a brief review. I know it doesn't seem like it was a brief review. It was about 30 minutes, but it is a very brief review of what you need to be aware of in order to understand how to correctly apply your measurement method, policy. So before we go into the examples, we're going to move into some additional issues and complications that come up when using the measurement methods, and then we're going to move into examples. Now, we've used up about 30 minutes like I explained, and this presentation will go for at least another hour. So let's talk about unpaid leave and change of status. Those are the 2 sort of big issues that come up when trying to deal with and administer your measurement method policy. And it applies to both the standard look-back measurement method and the initial look-back measurement method. And in the case of unpaid leave, it also applies to the monthly measurement method. But let's talk about the issue. For rehires or for employees who are returning from unpaid leave, must the employer identify and treat them as an ongoing employee or as a newly hired employee? In other words, somebody has been on unpaid leave, meaning you haven't had to give them credit for hours not actually worked. If it were paid leave, this wouldn't be an issue, right? Because you'd still be tracking their hours. But it's unpaid leave. Now, if it's an ongoing employee, if they come back and they're treated as an ongoing employee, there's no new initial measurement period. Employee comes back to the place he or she was in the cycle and the standard, and you must count hours of service in the measurement period before and after the break. If they come back as a newly hired employee, there is a new initial measurement period, and you don't have to give credit for prior hours worked or prior hours of service before when they come back. In other words, all those hours that they worked prior to their return get wiped away. And that is an issue for some employers. Some employers don't want to have to offer coverage, and it's more likely that they may have to offer coverage if they come back as an ongoing employee because they're going to have to give them credit. So it's an issue. So let's figure out how to deal with when somebody returns, whether they would be considered an ongoing employee or a newly hired employee. The solution that the regulators came up with was that they provided 2 different rules, the rule of parity and the 13 weeks rule, and you can select which of these 2 rules you want to apply. to your written measurement method policy. But again, this rule, the 13 weeks rule and the rule of parity, applies to the 13 weeks rule, the rule of, to not only the initial look back and the standard look back, but also to the monthly. Your first option is the 13 weeks rule. So where there are no hours of service under the 13 weeks rule, and the period is greater than 13 consecutive weeks. In other words, they were gone on unpaid leave for greater than 13 consecutive weeks. You may treat this employee as terminated and rehired as a newly hired employee. So in this case, they would go into a new initial measurement period, assuming that they came back not reasonably expected to be full-time. If they were reasonably expected to be full-time, then they would come back into the monthly. So where there are no hours of service for less than 13 consecutive weeks, they would be treated as an ongoing employee. And you would put them back in whatever cycle they were in when they returned. And count their hours and their hours of service that they accumulated prior to that, prior to them leaving. Examples. Employee takes unpaid leave for 15 weeks and returns. Because this employee was gone greater than 13 consecutive weeks, he or she would be considered a newly hired employee upon return. Another example, employees rehired 12 weeks after quitting. Okay, under this rule, because the employee was gone less than 13 consecutive weeks, this employee would be considered an ongoing employee upon return, and they would need to be put back in whatever cycle they were in prior to them leaving, prior to their absence or their departure. The second option is the rule of parity, which is actually called the at least 4 but less than 13 weeks rule. Now I'm calling, just as a side note, if you are an educational institution, the 13 weeks rule turns into the 26 weeks rule, and the rule of parity turns into the at least 4 but less than 26 weeks rule. But the way this rule works is where there are no hours of service, or where the period that they're gone is less than 4 consecutive weeks, they would automatically be treated as an ongoing employee. Where the period that they're gone is greater than 13 consecutive weeks, they would be treated as a newly hired employee when they return. What we are going to focus on is the period between those two. If they're gone for longer than 4 consecutive weeks but less than 13 consecutive weeks, you have a little bit of play that you wouldn't have under the 13 weeks rule. And the way it works is whatever number is greater wins. In other words, if the period of time they are gone is greater than the period of time that they worked, then they would be considered a newly hired employee when they return. If the period of time they worked in the cycle is greater than the period of time they were gone, then they would be considered an ongoing employee when they return. Let's talk some examples so this will make more sense. Employee works for 8 weeks and then they're gone for 5 consecutive weeks. Because the period of time they worked, which is 8, is greater than the period of time they were gone, which is 5, 8 wins. So this would be an ongoing employee when they return. Second example, employee works 5 weeks and they are gone for 8 weeks. So in other words, the period of time they worked in the cycle, it was 5 weeks, they left for 8 weeks, and because 8 is greater than 5, when this employee comes back, they're considered a newly hired employee. So they would not need to be given credit for the hours they worked prior to leaving that were part of that cycle. Employee has no service hours for 3 weeks. Well, in this case, they were gone for less than 4 consecutive weeks. So when they return, they would be considered an ongoing employee. The employee has no service hours for 14 weeks. This is the fourth example. This one's really easy too because they are gone for greater than 13 consecutive weeks. And anyone who's more than 13 consecutive weeks is when they come back considered a newly hired employee. Okay, let's apply this rule so you understand how it works. Now, for employees who are identified as ongoing when they return, this is what this slide is about. We don't have a slide for employees who are identified as newly hired upon return. We know already how to deal with newly hired employees because we have talked about that as a review at the first part of this seminar and also in detail in the measurement method seminar. So this slide only has to do with those who when they return are identified as ongoing employees. And what you need to do is you put them back in whatever measurement they were in when they left. And that would continue to apply as if they hadn't been gone. In other words, if an employee returns to work during a stability period in which the employee should be treated as full-time, after calculating the average of monthly hours, of course, which you would need to do when they return, the employee must be treated as a full-time employee through the end of the current stability period and must be immediately put on coverage. In other words, the point for this rule is when they return, if they were supposed to have been an ongoing employee and if, based on that and their earlier hours, they should have been on coverage, then you need to put them back on ASAP. They call it immediately, and they haven't really defined that in detail. It says as soon as the employee works at least 1 hour of service, which would mean that day, which is pretty fast and maybe not administratively feasible. So they added administratively feasible, which we think means it could be the first of the month after they return. But the idea behind that is there's not a new waiting period. If they come back as an ongoing employee, there's no waiting periods that apply. Waiting periods only apply to newly hired employees. Okay, there is an additional rule for those who are on special unpaid leave. And special unpaid leave is FMLA, USERRA, and jury duty. USERRA is military. So the 13 weeks rule and the rule of parity do not apply to special unpaid leave. In other words, you're going to treat these employees, no matter how long they were gone, as automatically as ongoing employees. So you don't have to take them through whatever rule you chose. Whether you chose the rule of parity or the rule of the 13 weeks rule, you just automatically say this employee is ongoing when they return. And when they return, you put them back in whatever cycle they were in, just like before on the prior slide. But you also need to give them credit not only for the hours they worked prior to, which is exactly what you would do in the circumstances on the prior slide, but you also need to give them credit or hours of service for the period of time they were gone. In other words, as if they were on paid leave. You don't have to pay for them, but you need to give them hours of service as if they had been. In other words, if they were gone for 2 months, you would give them hours of service credit for those 2 months. Okay, so that's the first issue that comes up with the measurement methods, and the second issue is change of status. This change of status only applies to the look-back measurement method. It does not apply to the monthly measurement method, just FYI. So what's the issue? For employees who move from full-time to part-time and or part-time to full-time, when do you offer or remove, whatever the case may be, from coverage? Well, the general rule is, and this is really important for you to understand with the look-back, the general rule in the look-back measurement method is changes or fluctuations in hours do not affect the classification of the employee as a full-time or part-time employee for the remaining portion of the stability period. In other words, you just follow the look-back measurement method rules, meaning that if they earned coverage during a measurement period, then they are locked into coverage for the associated stability period. However, there is an exception to this rule. And the exception to the rule is where there is a change in status. Now, the complication with this exception is that change in status has not been defined. So we're kind of in a gray area, and employers are going to have to choose how they deal with this. So the definition, we do know some things. We do know that change in status is actually a situation where somebody moves from one job to another. That is clear. But what we don't know is if change in status applies to someone who has exactly the same job, but they are now working part-time or they are now working full-time. In other words, this is not just somebody with variable hours. It's somebody who, for example, is working full-time. This is a female employee, and she's pregnant, she has a baby, and she now wants to work permanently as part-time. So you change her status from full-time to part-time. It is unclear whether in that situation or similar situations that is an official change in status for purposes here. Until further clarification, the most conservative approach is to apply the rules that would have an employer offer coverage sooner or keep an employee on coverage longer, because you're being conservative and you're being safe. However, you can choose how you define change in status for now, as long as it's reasonable. And you're going to want to clarify that and then apply it consistently. So once you've defined in your measurement method policy your actual definition of change of status, this is how the rules will apply. You've got 4 different situations. You've got 2 situations for the initial look back and 2 situations for the standard. This first slide is for initial and the slide after is for standard. So for initial, for employees who at the time there is a change in status, they are in the initial look back. The change is from a variable hour seasonal part-time employee to a full-time employee. When they have that change of status and go to full-time, the employer must offer coverage by the earlier of no later than the end of your waiting period. That's the waiting period that you have in section 1B of your measurement method policy, or the first day of the associated initial stability period. And that assumes the employee averages at least 130 hours per month during the initial measurement period. So in other words, whatever comes first, the end of the measurement period for initial, and you'd have to get them on sooner, or your waiting period. Now, if the change is from full-time down to variable hour, seasonal, or part-time, ideally, in reality or technically, there should not be a situation like this, because only newly hired employees who at the time of hire are not expected to work full-time are put in the initial look back. So you wouldn't have somebody who's in the initial look back who's full-time. But in reality, we have found actual situations that have emerged where an employee actually moves while they're still considered a newly hired employee from full-time to part-time and then back to full-time again, all before becoming an ongoing employee. And we don't really have regulations on how to deal with that situation. But the conservative approach would be to keep the employee on coverage, whatever option there is to keep the employee on coverage longer rather than taking them off. So the next situation is where we have employees who are in the standard look back, and we have 2 options here. For the standard, we have employees who have changed from who are changing from variable hours, seasonal, or part-time, and they're moving to full-time. In this situation, if an ongoing employee's employment status changes before the end of the stability period that they're in, the standard stability period that they're in, the change will not affect the classification as a variable hour seasonal part-time employee for the remaining portion of that stability period. The employee will not be eligible until day 1 of the next one. In other words, the simple way of explaining this is you're just going to follow the regular look back rules. If they move to full-time, that's great, but you don't have to move them to full-time until the next stability period. You don't have to move them to, you don't have to move them to eligibility before that time. Now, you can, of course, be more generous than that if you'd like. You can get them on sooner, but you would need to include that in your measurement method policy, in your written measurement method policy, and just explain that and then apply it consistently across the board. Now, if the change is from full-time to variable hours, seasonal, or part-time, so their hours are reducing and you want to or you think you should take them off coverage, this is what you do. If an ongoing employee's employment status changes before the end of a stability period, the change will not affect the classification of the employee as a full-time employee for the remaining portion of the stability period. In other words, it's the same answer as above, meaning you would just follow the normal look-back rules. However, if they're in this standard and they reduce the hours, if two situations exist, you may actually remove them off of coverage sooner than you would have to normally. And you may remove them as of the first day of the 4th month after the employee changes positions. But two things have to exist. First, that employee had to have been continuously offered minimum value coverage starting from the date of their original hire. And it doesn't have to actually be the day they started, but within whatever your waiting period was, as long as it's the waiting period that was within the rules. So they would have had to have been offered coverage consistently during that period through to current. That doesn't mean that they had to have been on coverage, but they had to have been eligible and offered coverage. And that employee must average for the following 3 months after the change less than 130 hours actually worked during that month. In other words, for the first 3 months immediately following the change, say for example January, they have to work under 130 hours. February, they have to work under 130 hours. And March, they have to work under 130 hours. And if they did, and those were the 3 months you're looking at, then they would be able to be taken off effective April 1. Okay, this slide is what I was talking about on the prior slide, meaning if there are lots of you who prefer a policy that is more generous than some of the change in status rules, specifically more generous than the following for the standard on the prior slide. If an ongoing employee's employment status changes before the end of a stability period, the change will not affect the classification, meaning if they go from part-time, variable, or seasonal to full-time and you want to get them on sooner than these rules here, you can certainly do that. And here's an example of how you could do that. You just need to make sure you put it in your written measurement method policy and apply it consistently. So these rules here under the ACA under employer shared responsibility are minimum rules. You can always be more generous. Here's an example of a more generous adaptation of the rule. If an ongoing employee's employment status changes before the end of a stability period, the employee will be eligible the earlier of day 1 of the next stability period or within the employer's waiting period as described in Section 1B. Whatever you ended up selecting for your waiting period, we call it the 90-day waiting period, but whatever you selected in your measurement method policy. Okay, we are now at a point in the seminar that we are going to be able to go through some examples. We've reviewed very briefly the rules, and then we've talked about some specific issues that have come up that are common in the unpaid leave rules and the change of status rules. And now we're going to walk through some examples, and hopefully this will help you better understand how to actually apply. We want you to have a measurement method policy, and it's great when you get that completed at the end of your step 4 or as part of your step 4, but we also want you to be able to apply your measurement method policy once you have it. That's an important step, and sometimes we found that is still a little bit tricky. So let's talk about it. Example 1. Here's our question. And this is all for initial and standard look-back cycles again. And these questions are real questions that I've gotten Some of the questions may have been adjusted slightly, but most of them are actually worded exactly how the employer asked them. What do I do with my 2 part-time employees who averaged 20 hours per week over the last 12 months? They haven't been offered coverage. And when does their next measurement period start? Is it a rolling 12 months or is it another 12-month measurement period starting now? Okay. So that is, I remember this question, it's word for word from one that I got. So we have several steps to walk through this. And the step 1 is to get specific key dates and information. You need to know the original hire dates for these 2 employees. The original hire dates in this case were June 11th, 2012 and June 24th, 2012. And they have never been offered coverage since they've been with this employer. Now, we also need to know when the first standard measurement period for this employer was, and the first standard was December 1 of 2013. That's when they first started tracking. We don't need to know, sometimes in examples we need to know when the initial look back date started, but we don't, and what the policy is that they selected, but we don't need to know that here because these 2 employees, for ACA purposes, have always been ongoing employees. These 2 employees are considered ongoing because they were hired before the very first standard measurement period. Anyone hired in this case for this employer after December 1st is considered newly hired, and they were hired before then, at least temporarily. Anybody hired after that becomes ongoing after the first full measurement period, standard measurement period after hire. So that's what we need to know for this scenario. So the question is, when do I track these employees? Well, because they're ongoing, we look at the ongoing look back, in other words, the standard look back. And this first standard look back dates and measurement for these 2 employees should have been December 1st, 2013 through November 30th, 2014. And then again, December 1st, 2014 through December 30th, 2015, and then again December 1st, 2015 through November 30th, 2016. You get my point, right? This one's a pretty, our examples will get more and more complicated. This is the least complicated one. So for anybody who is part-time, or anybody for that matter for this employer, because I know this employer chose the look back for all categories of employees, these employees should always be measured from December 1st through November 30th every year. Not on a rolling whatever random one, but specifically within this time frame. Example 2, question. I have a newly hired employee not reasonably expected to be full-time at the time of hire. I put him in the initial look back, which is right, which is correct, and he averaged part-time hours over the 12-month period. No coverage was offered, which is right, that's correct. But when does that same employee's next measurement period start? Okay. So, step 1, we need to gather specific key dates and information. First of all, and this is what you'll do when you have a question that comes up, you're going to look at the original hire date. When was this newly hired employee hired? September 12, 2014, and this employee was not offered coverage up front but was put in the initial look back. We know that. The initial look back they chose is a 12-month measurement period and a 12-month stability period with a split administrative period. We also need to know when this employer's standard starts. The employer's first standard starts, and again this is anybody who's hired after 12/1/13, it starts for this employer, and again this is a real question, theirs starts December 1st, 2013, that was the first one, went through November 30th of 2014. So we have our gathered information. Now we need to go through in step 2 the initial look back dates for this particular employee. The hire date was September 12th, 2014. So this employee's initial administrative period, part 1, remember because they have a split, is September 1st through September 30th of 2014. Then this employee went into the measurement period, which went from October 2014 through September 2015. Their administrative period for this employee was October 1st through October 31st, 2015, and the stability period started November 1st, 2015, and went for 12 months. Now, the standard dates for this particular employee are important to determine as well. The standard look-back dates for this particular employee started December 1st, 2014, because that's the first standard measurement period that started after the hire date of September 12th, 2014. So then you can see here that the regular dates are December through November of 2015, and the stability period started January 1st of 2016 and goes for 12 months. So now that we know what those periods are, let's actually apply it to this employee, and determine what and when this employee needs to be offered. So during the initial administrative period, part 2, of course, is when this employer would do the math. The initial measurement period was October 1st, 2014 through September 30th, 2015. The total hours over that 12 months was 1,253. You divide that by 12 and you get 104.4. That is not an average of 130 hours per month. That's an average of 104. So that means this employee was not full-time and is not eligible and did not need to be offered coverage. So, and I think that's what happened for this particular employee. But the next question the employer had was, well, when is the next cycle? Well, the next cycle is the first standard that happened after the date of hire. So let's talk about what happened in that standard. The first standard measurement period after hire was December 1, 2014 through December 30th, 2015. In that 12-month period, that particular employee had 1,590 hours of service. The average, if you divide that by 12, the average hours of service is 132.5, and that is in fact full-time, because anything 130 or more is full-time, and that employee would need to have been offered coverage effective January 1, 2016. And again, for this particular employee, that cycle, the standard cycle, would repeat. Okay. Example 3. I have an employee who was hired to work full-time and she was offered health coverage up front. She opted to enroll. She later went part-time status and her coverage was canceled at the end of the same month. Was it okay to cancel her coverage at that time? As indicated on the slide, this is a change in status question. So we're going to gather specific key dates and information. The original hire date was April 4th, 2015. The employee at the time of hire was reasonably expected at the time of hire to be full-time, and so she was offered coverage according to their policy effective June 1st. That is what we discovered when we went to their measurement method policy, because we needed to know when that waiting period was, but that's when it was. The date she went part-time was March 12th, 2016, and she was taking coverage off by the end of that same month. Now our step 2 is to determine the next standard look-back date after date of hire. We're not looking for anything other than the standard. Standard measurement period was November 1st. The next standard measurement period that happened after date of hire was November 1st, 2015. So she would have been put in that cycle. And the stability period was effective January 1, 2017. So determine what measurement method employee is in at the time of change in status. Okay, so let's talk about this. Employee's original hire date was April 4th, 2015. The monthly measurement method continues until the end of the first standard measurement period after hire, the end. So in other words, remember, because this employee was reasonably expected to be full-time at the time of hire, and this employer elected to use the look back for all employees, the standard look back for all categories of employees, this employee initially went into the monthly measurement period temporarily and then would need to be transitioned into the standard. So that's why we're talking about the monthly here. The monthly measurement method started April 4th, 2015, and continues until the end of the first standard measurement period after hire. The end of the first standard measurement period after hire is October 31st, 2016. The change in status to part-time position was earlier than that, was March 12th, 2016. So the conclusion is the employee was still in the monthly measurement method and is still considered a newly hired employee. They're still considered a newly hired employee because they're ongoing. They become ongoing at the end of the first standard. And the end of the first standard, remember, here is October 31st. So they're still considered newly hired, and they are still in the monthly. Of course, the standard measurement method started, but we're not at the end of the standard. So let's look at this chart again. Remember, if you look over in the newly hired employee reasonably expected to be full-time, this employee got put into this bucket and was put into the monthly measurement method and is eventually transitioned into the standard look-back measurement method. Now, the standard started but hasn't finished yet, so they're still considered newly hired. So step 4 of this, to get the answer to this question, is we need to review the applicable section of the employer's measurement method policy. What does the employer's monthly measurement method rules state? If an employee has, for this particular employer, we went to what they chose, and this is what they chose in their measurement method. It said if an employee has at least 130 hours of service per month for the first month of employment, that employee will be offered coverage as of the first day of the following 2 months of employment. As of the first day of the month following 2 months of employment. That's not really what applies here. We're looking at when they can be taken off. So the next paragraph in their measurement method policy says, an employee who is enrolled in the employer's group health plan but who works fewer than 130 hours per month for 2 consecutive full calendar months may cease to be eligible as of the first day of the next calendar month. So this particular employer's monthly measurement method policy states that if somebody who's in the monthly measurement method and they end up working less than full time, they can be taken off coverage after 2 full calendar months. So let's apply it. Employee was offered coverage effective by the first day of the month following 2 months. In other words, they were hired April 4th. She was hired April 4th, and coverage was effective June 1st. That applies the first paragraph in italics above. Now, the change in status to part-time was March 12th. And we know that she's still in the monthly measurement method. The first day of the month after 2 consecutive full calendar months is June 1. So we have April and May, and June 1 is the first that they should have taken this employee off. Instead of taking the employee off coverage at the end of March, so it was effective April 1, the employee should not have been taken off coverage until effective June 1. And again, that's because of what they selected in their measurement method policy, and specifically what their monthly measurement method policy is for when somebody's hours reduce. Okay, now here's the kicker. We're still on example 3 because we don't want to forget to apply the first standard look-back cycle under which the employee's hours of service are also being tracked. So she's still in the monthly, but we still have that standard that's still applying, and we haven't gone through it yet. So they could take her off coverage effective June 1, but the last day of the first standard measurement period after hire is October 31st. So during the standard administrative period, which is November 1st through December 31st, they're going to average the hours for this particular employee over that 12-month standard. The standard stability period starts January 1, 2017 and ends December 31st. Now, if during that standard that employee's hours averaged, even though the employee's hours went down, remember, but if they averaged 130 hours or more during that period, and we didn't know in this case because we haven't hit the end of 2016 yet, so we have to just see what those hours end up showing. If the average is 130 hours or more, then she needs to be put back on coverage for that one stability period, that full 12-month, and then she would be taken off again, assuming that she continues to be part-time. Now, The employee can, of course, opt to not take that coverage, and that's likely what she will do. I would imagine, because I hear stories about how people who go part-time can't afford to pay for the coverage, but that's what the rule is. Okay, we are now on example 4, and it's another change in status example. And here's the question. I have an employee who has been a full-time employee the entire time she has been with us, but is moving soon to a part-time position. She tells me I need to keep her on coverage for 4 months after she moves to part-time, pursuant to the Affordable Care Act. When do I take her off coverage? Again, these are all real examples. This particular employer had an employee who's gotten educated a little bit about the rules on the Affordable Care Act, and specifically on the employer shared responsibility rules. Now, it's important to understand the rules so you know when to correctly take this employee off. So again, like with all our other examples, we're going to first gather specific key dates and information. The original hire date for this particular employee was May 18, 2015. Employee at the time of hire was expected to be full-time and was offered coverage on July 1st per this particular employee's waiting period. So their waiting period was first of the month following 1 full month, and that's why they were put on July 1. Hours were tracked using the monthly measurement method, of course, because she was reasonably expected to be full-time at the time of hire. And the initial look back is not applicable, so we don't have to figure out what the initial is. For this employee, we're going to look at the monthly measurement method and then the standard. The date the employee is moving to part-time position is June 1st. And again, I've already said this, but the newly hired employee is reasonably expected to be full-time, so they get put in the purple bucket. First of all, their hours are measured using the monthly measurement method, and then they're transitioned into the standard look back. So let's find out when the first standard look back occurs after date of hire. The first standard look back date after hire is November 1st, 2015. And the stability period starts January 1. So, Step 3, determine what measurement method was being used at the time of the change in status. And we're assuming, for purposes of the example, that there was an actual change in status. Her original hire date, again, if you recall, was May 18, 2015. The monthly measurement method continues until the end of the first standard measurement period after hire. The end of the first standard measurement period after hire, as you recall, is October 31st, 2016. The change in status to part-time will be June 1st, 2016. So the conclusion is, when the change in status occurs, the employee will still be in the monthly measurement method and is still considered a newly hired employee. This, of course, again, to repeat, is because she will become an ongoing employee only at the end of the first standard measurement period after hire, or specifically on October 31st, 2016. So step 4, review applicable section of employer's measurement method policy. So the employer's monthly measurement method policy, not the look back, but remember the monthly, that you're required to put a newly hired who's reasonably expected to be full-time in, says this. An employee who at the time of hire is reasonably expected to be full-time will be eligible for coverage effective no later than the first day of the month following 1 full calendar month, as described in Section 1B. If thereafter an employee continues to work at least 130 hours of service within each month, that employee will remain eligible for coverage through the monthly measurement method. Okay. They did that correctly. They got her on correctly. But what we're looking at is when we can get her off. So the next paragraph says, if an employee who is enrolled in the employer's group health plan and whose hours are being tracked using the monthly measurement method works fewer than 130 hours in 1 calendar month, that employee may cease to be eligible as of the first day of the next calendar month, but may become eligible again under this method if hours increase to at least 130. So in this case, the employer said that they only, if just after 1 month they work under 130 hours, they can be taken off the next calendar month. So let's apply this. The monthly measurement method applies. Remember, we're not looking not the look back and the change of status rules, because we're currently in the she's still newly considered newly hired employee, and we're still doing the monthly. Now the standard started, but it hasn't finished. The change of status to part-time position will be June 1st, 2016. The first day of the month after one full calendar month is July 1st, 2016. So assuming the employee's hours for full calendar month of June are under 130 hours, she may be taken off coverage effective July 1. Okay. That's the answer. But again, like in example 3, we have to remember that we have to also apply the standard look back cycle under which the employee's hours are also being tracked. So the last day of the first standard measurement period after hire, remember, is October 31st. The standard administrative period is November 1st through the end of that year. So if the hours over this 12-month period, and we won't know this until the end of the year when they get in the standard administrative period, if they are over or 130 hours or more, the employee should be offered coverage again, even though they could be taken off on effective July 1st. They would then be put on again effective January 1 through the full stability period. And of course, again, like in the other example, the employee may opt out of coverage if they'd like, but if not, and assuming the hours average over that 12-month period are 130, then they need to be offered coverage again. If the hours are not, then they don't need to offer. Example 5, and just so you know our pacing, we have 6 examples, and then we'll be finished with the presentation. So the question in example 5 is, I have an employee, and again, this is a real question. I have an employee who was hired as reasonably expected at the time of hire to be full-time, but then she wanted to move to part-time. Then she just went back to full-time a few days ago. When do I need to offer her medical insurance? Now, when I go through questions like this, I wanted to check compliance at all levels. So I checked whether whether she was taken off at the appropriate time, and then when she needs to be put back on. And you'll want to do this to double check. It's like a self-audit when you're going through this on your own, to make sure you did everything correctly from the beginning. So step 1, we want to gather specific key dates and information. The original hire date for this particular employee was July 28, 2008. The employee was offered coverage at the time she was hired and has been eligible consistently ever since then. Hours were tracked back then using the monthly measurement method, and initial look back is not applicable in this case, of course. And the date she went part-time was January 31st, 2015, and the employee consistently worked under 130 hours each month for a year, so she truly was part-time, and then went back, at least worked part-time hours, and then went back to full-time January 25th, 2016. So just as a refresher, here's the chart. So hopefully you have this memorized because I've shown it to you so much, but here's your chart as a refresher if you want to look at it just for a moment. Okay, step 2 is review standard and or initial look back dates. We're not reviewing initial because it's not applicable here, but we're going to look at the standard. The standard measurement period for this employer is every year on November 1st. And the standard stability period starts every year on December 1st, and they have a 1-month administrative period. So step 3 is determine what measurement method is currently being used. Her original hire date was July 28th, 2008. The first standard measurement period for this particular employee was November 1st, 2014. So this employee is an ongoing employee and has been since the employer started the measurement method. So her hours of service are currently tracked in the standard look back. There was no need to check initial look back dates, and there's actually no need to check on the monthly because she was with this employer at the time they started this measurement method process. So the first change in status we're going to be talking about, because we're going to check that from full-time to part-time, make sure that was correct, and then we'll talk about the second change in status from part-time to full-time. Okay, so from full-time to part-time, we're going to step 4, review applicable section of the employer's measurement method policy. In this case, you're going to pull if you have this question, whatever it is, you're going to pull out your measurement method policy and read it and see, in this case, the measurement method policy section that is for those whose hours are tracked in the standard look back, and the change in status is from full-time to part-time. So what is their rule? In their rule, they had, it states in their measurement method policy, it states if an ongoing employee's employment status changes before the end of a stability period, the change will not affect the classification of the employee as a full-time employee for the remaining portion of the stability period. However, if two specific situations exist, employer will remove employee from coverage as of the first day of the 4th month after the employee changes positions. Now remember when we talked about the change in status rules, we had specific rules for initial and specific rules for standard, and we're in the standard. Okay, so those two situations have to exist. First, employee had continuously been offered minimum value coverage starting from the date of hire through the current change in status, and the employee averaged fewer than 30 hours per week or 130 hours per month, which is how I like to do it, for each of the first 3 months immediately following the change in status. That's what the rule says, so let's apply it. Step 5, because her hours were being tracked in the standard look back, and because she had been eligible and offered coverage since 2008 consistently since she'd been hired, she may be removed from coverage on May 1st, 2015 if, after her change in status to part-time on January 31st, 2015, she averaged less than 130 hours for February 2015, for March 2015, and for April 2015. So assuming for each month separately she had worked under 130 hours, and we know that she did because we had that information we gathered on the prior page, then she could be taken off coverage effective May 1st, 2015. Now, here's the second change in status. This second change in status is from part-time to full-time. So step 6 is review the applicable section of the employer's measurement method policy. In this case, the measurement method policy section that is for those whose hours are tracked in the standard and the change in status is from part-time to full-time. Here's the rule. If an ongoing employee's employment status changes before the end of a stability period, the change will not affect the classification of the employee as a variable hour seasonal part-time employee for the remaining portion of the stability period. The employee will not be eligible until day 1 of the next stability period. So that's the rule, so let's apply it. Because this employee's hours were being tracked in the standard look back, and because her status changed from part-time to full-time, she is not eligible for coverage until day 1 of the next stability period. She changed from part-time to full-time on January 5th, 2016, and day 1 of the next standard stability period is December 1, 2016. She is eligible at this time, assuming that in the associated measurement period she averaged over that 12 months of 130 hours or more per month. If she didn't, she doesn't get offered coverage even then. Now, again, as we talk, I've moved to the next page, but as we talk about that prior page, if the employer changes the policy to allow them to put her on sooner than that, you can certainly do that. These rules, again, are minimum rules that need to be met, and you can always be more generous. Okay, on to our example 6. It's our last example. The question, again, deals with change in status because that's by far the most common question we're getting, and here it is. How do we handle an employee who is hired for a part-time position and whose hours of service were measured in the look back? He was promoted to a full-time position where he was offered benefits, but he declined. During the next open enrollment, however, he accepted benefits and is currently enrolled. He is now moving again to a different position that is considered part-time. So in this case, and this is a real example, we had somebody who went from part-time to full-time to part-time. So again, like we always do, we need to gather specific key dates and information. The original hire date was June 7th, 2014. In that case, as we know, the employee was not offered coverage at that time he was hired, but instead was put into the initial look-back cycle because that he was not reasonably expected at the time of hire to be full-time. That's correct. Date this employee went full-time was March 30th, 2015. So almost a year passed. The employee was offered benefits effective the following day, April 1. But that employee declined. He declined. During the next open enrollment, however, which was the fall of 2015, he opted into coverage effective January 1. Then the date this employee went back to part-time is April 26, 2016. You may just, by the way, want to stop the recording and kind of let this process, because this is a really complicated one. So you can stop and look at it and read it so that to make sense, to make sure you're caught up with this, because I know it takes a minute to process. Last bullet point is the initial look back is 12-month measurement period, and the stability period is 12 months as well, with a split administrative period. So let's move on. Step 2. Determine the initial look back dates for this employee. Again, we're dealing with the look back because this employee was at the time of hire not reasonably expected to be full-time and therefore was put into the initial look back and then is transitioned into the standard. But here's the dates. Hire date was June 7th, 2014. The initial administrative period part 1 was June 7th through the end of the month of 2014. Then the initial measurement period goes for a year for 12 months from July 2014 through June of 2015. The administrative period is only 1 month because it's a split administrative period and because it's initial. And that is from July, for the month of July in 2015, and the stability period was August 1st of starting 2015 and going through July of 2016. Now we also need to know what the next standard look back dates after hire were. The standard look back that started after this employee was hired was December 1st, 2014. And the stability period is January 1st, 2016. Okay, step 4. Determine what measurement method was being used at the time of the first change in status. Okay, his original hire date was June 7th, 2014 for the part-time position. The change in status to full-time position started the following year on March 30th, 2015. Conclusion. This employee was still in the initial measurement look-back cycle and had not yet become an ongoing employee at the first change in status. This is because he became an ongoing employee at the end of the first standard measurement period after hire, or at October 31st, 2015. But the change was March 30th, which is earlier than that. So again, here's the graphic so that you understand and you can see that this particular employee is in the middle bucket, the teal bucket that says newly hired employees not expected to be full-time. And so he went into the initial look-back measurement method and then is in the middle of being transitioned into the standard. But because he's still in the look-back, he's still considered a newly hired employee. So that is the rule we're going to look at for change in status. So this slide has to do with the first change in status from full-time to part-time, and then we're going to have some slides that deal with the second change in status that goes from part-time to full-time. So in step 5, we're going to review the applicable employer, the applicable section of the measurement method policy for this particular employer. In this case, the measurement method policy section that is for those whose hours are tracked in the initial look-back for when the change in status is from part-time to full-time reads as follows. Employer will offer coverage by the earlier of employer's 90-day waiting period as described in section 1B, or the first day of the associated initial stability period, assuming the employee averaged 130 hours per month during that initial measurement period. Okay, so that's the rule. That's what the measurement method policy says for this employer, and we actually turned to that and looked at it. So, and that's what you will need to do. You need to know what your measurement method policy says, and you need to turn to that because that's your rule book. So, step 6, we're going to actually apply these rules to this situation. This employer's 90-day waiting period in Section 1B says that an employer is offered coverage no later than the first day of the following month after start date, so April 1st, 2015. So the first day of the associated initial stability period is August 1st, 2015. So the first day of the associated initial stability period is August 1st, 2015. So we need to find out which one was earlier, right? Because it says the earlier of the 90-day waiting period or the first day of the associated stability period. Well, the earlier is April 1st. So he should have been offered coverage and been eligible for coverage April 1st, 2015. So, assuming that was correct with this employer, and it was, the second change in status was from full-time to part-time. So we need to determine what measurement method was being used at the time of the second change in status. So let's look at it. His original hire date was June 7th, 2014 for the part-time position. The change in status to full-time position was March 30th, 2015. The change in status back to part-time position was April 26, 2016. Conclusion: this employee became an ongoing employee at the end of the first standard measurement period after hire, or on October 31st, 2015. So at this point, for the second change in status, his hours are being tracked in the standard. So he is considered an ongoing employee. So we're going to look at the standard, the rules for change in status under the standard. And again, here's just the chart again so you can see that this particular employee is in the middle bucket again, newly hired employee not expected to be full-time. He moved to the initial look-back measurement method, but now he's moved to the standard. He's completed the first standard, and so we're going to be looking at the rules that deal with standard. Okay, now that we figured out the first change in status, we need to talk about the second change in status. And the second change in status is from full-time to part-time. So step 8 is review your applicable section of your written measurement method policy that deals with this. And in this case, it would be your standard for those whose hours are tracked in the standard look back, and the change in status is from full-time to part-time. If an ongoing employee's, and this is what this particular employee's section read, if an ongoing employee's employment status changes before the end of a stability period, the change will not affect the classification of the employee as a full-time employee for the remaining portion of the stability period. In other words, you're just going to follow the normal look-back rules until the end of the stability period. However, if two specific situations exist, employer will remove the employee from coverage as of the first day of the fourth month after the employee changes positions. So here's that exception we talked about. So the exception, if you recall, again, is two things have to exist. First, the employee had to have continuously been offered minimum value coverage starting with the date of hire. And second, the employee averaged fewer than 130 hours per month for each of the first 3 months following the change in status. So let's apply it now. Let's apply this actual policy that is written in this employer's measurement method policy to this particular employee. This employee started out as a part-time worker, so for this exception, it doesn't apply because he's not been continuously offered minimum value coverage from the date of hire. He wasn't offered coverage because he was part-time. So the exception doesn't apply, and so the first part of this paragraph that's in italics does apply, which says again, the change does not affect the classification until the remaining portion of the stability period. Now, so that they wouldn't be able to take this employee off coverage until that time. So hopefully that makes sense. That is the end of our presentation today. Thank you so much for listening. You may want to listen to it again because I know this is a lot to take in, but hopefully the examples helped you better understand how to actually apply your policy. I would, as my next step as an employer, I would pull out my measurement method policy that's in writing and make sure I and anybody else who's going to actually need to apply this understands what, reads it and understands what's in it, and understands that it's important to go to that measurement method policy each time we have a question about whether somebody needs to be taken on or off coverage or anything else that has to do with the measurement method policy. Of course, if you have questions about a particular situation, we are happy to help. And we would hope that you will continue to enjoy our seminars and take advantage of them. Thanks so much. Good luck.